Question number 3 on frequently asked questions. What is a market maker? A market maker, MM, is a firm or individual who actively quotes two-sided markets in a security, providing bids and offers known as asks, along with market size of each. Market makers refer to a company or individual that engages in two-sided markets of any given security. A market maker seeks to profit off of the difference in the bid-ask spread. The purpose of a market maker in a financial market is to keep up the functionality of the market by infusing liquidity. Consider a situation where a market maker in a stock alpha can provide a quote for $5 or to $5.50 for 100 to 200 shares. It means that they want to buy 100 shares for the price of $5 while simultaneously offering to sell 200 shares at the same security for the price of $5.50. The offer to buy is known as the bid, while the later offer to sell is the ask. So the purpose of a market maker in a financial market is to keep up the functionality of the market by infusing liquidity. They do so by ensuring that the volume of trades is large enough and such that the trades can be executed in a seamless fashion. Now, the absence of a market maker, an investor who wants to sell their securities will not be able to unwind their positions. It is because the market doesn't always have readily available buyers. So, in other words, if you want to sell your stocks or your securities and there isn't a market maker, if we didn't have them, you would actually have to wait until somebody actually was on the other line talking to your broker wanting to buy those exact amounts of shares. So think of it kind of this way as the example earlier with the two gorillas and the monkey in the middle running back and forth. A market maker is actually somebody in between that is, let's say, a third gorilla standing in the pathway between the two gorillas, interacting with the broker, which is the monkey running back and forth. And this big time gorilla in the middle, regardless of the amount of bananas gorilla number 2 has, the one you want to buy from, will offer X amount of bananas to you to speed up the process of purchasing them without delay, with the assumption that the gorilla number 2 with all the bananas has enough bananas to fill your order or other orders that come in from other gorillas that want bananas. Where it gets wishy-washy is that if the market maker decides to create more bananas than there are available and have been produced and grown on the trees and stored in those factories, if they decide to create 10, 20, 30 times more bananas than there actually are in the factories in volume, that can actually drive the stock price value down because there's more supply than there is demand. And that's where we get into some really strange and, well, places where we need to find out who's holding these market makers accountable. One example of a market maker is Citadel. Melvin Capital, I believe, but I don't know if they're still in operation. Anyway, thanks.